Welcome everyone to our quarterly Outlook video. My name is Kevin DeHaad, President and CEO of CWB McLean & Partners. And I'm pleased to be joined by Scott Blair, our Chief Investment Officer, who's here from Victoria. Welcome, Scott.
Thanks for having me here in Calgary.
So, Scott, about a year ago to this point, we did an Outlook video like this. And in that video, it was an opportunity to introduce you to our clients as Chief Investment Officer, and also really talk about how you were bringing the research teams together. We had a research team in Calgary, we have one in Edmonton, we have one in Toronto, you're in Victoria, and we decided as a management team together to, bring these teams together, it'll improve our results and give us much more depth in each asset class, right? And really allow our research team to focus. I think there's 15 investment professionals now on the team. So that was a year ago, and I'm curious, how that went from your perspective, what worked, what didn't work, and kind of what you're working on with the team as we embark on 2022.
Yeah, thanks, Kevin. It's great to be in person, right? and not doing this through a Zoom call or a Microsoft Teams call. It was last year was a pretty intense year for us, for everybody really. I know out there for our firm and on the investment team, there was a lot of change. So as you said, we took these three investment teams that were running similar strategies across the country. We assigned some team leaders, senior PMs. We moved some people around from one team to another team, so people had new responsibilities. And in some cases, people were working with people they'd never met before.
Right.
And although they've met now, some of them have never met face to face. We tried a few times to get together as a team, but it just hasn't been possible. So there was a lot of change and uncertainty in how it would work. But we knew it was the right thing for the long term, that it was the right thing to do. We just, with all the change, how would it work in the short term?
Right.
And it's been a year now, and I got to say I'm super pleased with the results, like the tangible results, the returns in the portfolios and strategies that we run. We had a really great year, not only absolutely, but relative to the market. So, that's super encouraging, the year that we had. And then the other thing is just the way the teams have gelled and come together as one team has been much better than I could have ever imagined. We've had super leadership from some of the people like Rick Palumbi here in Calgary, who has really bought in and was super supportive of this being the right thing for our clients and the right thing for our team. So it's gone much better than I thought, and it would. I knew it would go well, but it's gone much better, and I'm really pleased. Such a talented team. The other thing I would say, that something that we could do a little better or that we have to work on next year is cross-pollination across the different teams. Like we have that going now, idea generation. Let's talk about different things that are going on in the market. Let's get different views. But there's only so much you can do in a virtual world.
Right.
We need to get together face to face. We've tried to have a couple of off-sites through the year that we've had to cancel.
Right.
And that's going to be a huge imperative. Let's get everybody there so they can have this type of interaction that we're having here today.
Right. Super. Yeah, and I liked what you said earlier, Scott. It's the right thing to do for our teams, and it's the right thing to do for our clients. And the results obviously been pretty good too. So super. Yeah. Congratulations on a great year.
Thanks, Kevin.
When we look at building portfolios for our clients, I like to think of it like a toolbox. I call it the investment toolbox. And yourself and the research team are responsible for building investment strategies in that toolbox. And then people like myself and the other client portfolio managers across the country build portfolios for our clients, using various tools in the toolbox, because every client is different and unique and requires different tools, quite frankly. So we have a larger team. We have more resources at our disposal within our team. Are there any new tools, if you like, that you're looking at developing this year and into the future?
Yeah, that's a huge advantage of having a larger team, is our ability to do some different things.
Right.
So one of the things we want to do in 2022 is to launch a North American small mid-cap fund. And that's going to be run by Edward Friedman, who, as many people that'll be watching this today know, Edward has ran the CWB M&P Canadian equity strategy for many years. He had some really great results, especially through the pandemic. And a lot of his results came from a focus on small and mid-cap stocks.
Right.
So we've seen his expertise there, and now we want to take advantage of that. So Edward came off the Canadian team about a year ago. He's been working again on the international team. But in the background, we've been building the business case, building out how these strategies would work for our clients, how they'd fit into portfolios. And now the real work of researching names that are going to be in the portfolios begun. And we hope by mid to late 2022, we're going to have this launched. So that's a big imperative. And the second thing that we're looking at is a strategy with regards to alternative investing. And I know I'm sure we're going to get into it, interest rates, bond yields, all that kind of stuff. So alternatives like private debt, private equity, infrastructure, those kind of things, we're taking a look at those asset classes. They can provide some yield enhancements potentially with low yield environment that we're in with bonds. So we're doing a lot of due diligence there. It's a complicated space. There's liquidity constraints. There's minimum investment sizes. So we have to do our due diligence, but we'll have more to say through 2022. And Kevin, you've been very involved in this and quite passionate about this asset class, so we'll have a lot more to say.
Super. Yeah, I have to admit I've enjoyed working with you and the rest of our internal investment committee, looking at infrastructure managers, real estate managers, and all that. So I know there's a lot of great progress there that we can share with our clients in the new year. Okay, let's talk a little bit about the investment climate we're in right now. And I'm not going to bring up inflation too many times because we're getting emails every day about inflation in the U.S. Federal Reserve. But there's, in my 20 plus year career of investing, there's not too many things that are, norms or things you can rely on with the market. But one of them you got to pretty much pay close attention to is the U.S. Federal Reserve and what the U.S. Central Bank is doing. And there's a saying, the Fed is your friend or they're your foe. And in 2020 and 21, they were our friend, right? They were cutting interest rates, they were buying all kinds of bonds, and they were pumping liquidity into the economies in the system. And, that's changing. They're, likely going to raise rates this year, and they're reducing their bond purchases. So there's all kinds of different views on how that's going to impact markets and asset classes this year. So how are you thinking about the Fed and that interplay with the markets?
Yeah, it is the topic of the day.
Yeah.
Right. It's like you said, for sure we're going to see rate increases with the Fed. We're going to see the Bank of Canada. Really, central banks almost everywhere in the developed world are going to be raising rates and taking liquidity out of the system. But that being said, I'd say 2022, as we sit here in January, the outlook for 2022 is a continuation of 2021 without the extremes.
Okay.
So in 2021, we had really robust GDP growth. We're still going to have GDP growth. That's the forecast for 2022, just not as robust, but above average. We had great corporate earnings in 2021, and in 2022, we still expect to have solid corporate earnings, 7-8% in the States is the forecast right now. So not as strong, but still strong. We had a lot of liquidity out there in the system. We had a lot of savings. People had excess savings through all the government programs and whatnot. There's still excess savings out there, just not again at the extreme.
Yeah.
And most importantly, we're still going to have low interest rates. Like even if they increase, they're still going to be low relative to history, just not at the extreme lows that we had in 2021. And history shows us that when rates are starting to rise, if they're rising because the economy is doing well and whatnot, that's actually can be a good environment for the stock market. So right now, we're not really that concerned about it, but it is hugely on our radar. It's not super positive, obviously, for bonds, or it may not be positive, but we have other options that we're looking at in the bond, or that we can look at in the bond world, things like preferred shares and floating rate debt. And the CWB M&P Diversified Fixed Income Fund has big chunks of those kind of things in there that could help protect portfolios from inflation and bond yields rising.
I like how you phrase that. It's like the similar to last year, but not at those extremes, right? And there's some foundations. And, quite frankly, we've seen more volatility to start 2022. And volatility, for an active manager, volatility isn't a terrible thing either, because it gives us opportunities to invest. So.
Yeah, that's true. Like where we start to get concerned about interest rates rising is 2023. Like if inflation, we're expecting inflation's going to come off in the second half of the year. That's the forecast out there now. But it still looks like it'll run a little hot through to next year, and the Fed will keep rising. And there's an old expression, Kevin, I know you know it well. Bull markets don't die, they're murdered by the Fed.
Right.
And so if the Fed increases rates too quickly or too much, then we could end up in some real issues. But we think that's a 2023 problem.
Right.
But it could become a problem sooner. It may not be a problem at all. That's the biggest thing that we're really looking at.
Right. Got it. Yeah. So that's a key risk you're watching is the Federal Reserve kind of making a policy mistake. Are there any other risks on your radar over the next year or so?
Well, there's always, the biggest risk that we have out there, and all the risks really that are out there right now, they're all COVID related.
Right.
Inflation's about COVID, supply chain's about COVID, like everything is COVID related. So the biggest risk that we have in the economy today still remains COVID and all the knock-on things to that. So
right.
If this variant we have now starts to fall away and we get, some sort of herd immunity, I'll use that term, but you know what I mean.
Yeah.
People get a little bit immunity, and then we have a pandemic turns into an endemic or an endemic. Then we end up in a situation where a lot of spending could move from goods to services, and that will help to ease inflation. That's really what we're hoping happens through the year. But that is the main risk that we see is COVID. It's still driving the bus on everything that's going on in markets and whatnot.
Right.
And inflation really is an outgrowth of that.
Yeah. Okay. And just finishing up with our last question today, we take a global approach to investing across the entire organization. Canada, US, international. Last year, our US equity pool did 35%. Great year, as you referenced earlier. Our international pool did just under 9%, which in a normal year would be pretty good. But obviously, international markets lagged last year. Canada did well too, I think in the mid-20s. So as you're kind of looking across geographies, where do you see value and what are your thoughts there as far as those asset classes?
Yeah, I mean, what a year, right? I got to say, in the depths of March 2020, it certainly did not see the kind of equity market returns
right.
that we've had since then. But we'll take them, right? And the U.S. market has been just on fire. It's been on fire for a very long time. It's been outperforming other global markets. And at the start of every year, strategists tend to say, I think this is the year that international markets are going to outperform the U.S. market. And there's been a few years there, but it hasn't really happened. So what we see happening in the U.S. market and the volatility we're having so far this year is it's really impacting as rates rise. That impacts those long duration stocks, the tech stocks that have this huge runway, but a lot of their earnings are well out in the future.
Right.
And as rates rise, those stocks tend to get hurt a little more, and we're seeing that as we start this year. So there is reason to believe that more cyclical markets that don't have that high tech weight this year, places like Europe, places like Canada, could benefit from that and be outperformers this year.
Right.
That's not really a prediction. We always focus on a diversified portfolio because
right.
you never know what's going to happen. But there is good reason to believe that international will have a good year this year in Canada as well.
Right.
And some of that return on the international fund last year, a lot of those international markets actually did better than what the index did or international pool. It's just converting it back into Canadian dollars.
Right.
Had a dampening impact because the Canadian dollar did so well versus a lot of other currencies,
right.
even versus the U.S.
Right. Yeah. Good point.
So we still advocate that diversified portfolio. We think that within the U.S. market, there's lots of great opportunities.
Yeah.
That's a big reason why we want to start this small mid-cap fund.
Right.
There's a huge reshoring that we think is going to happen in the States. There's been trade wars, and we've seen the supply chain issues.
Right.
And that reshoring, if they build factories and bring production back into the U.S., will be really beneficial for a lot of small mid-cap companies.
Yeah.
Companies that have market caps maybe under $10 billion. So it's a pretty exciting time for the markets, and it's a pretty interesting time, but we still see lots of opportunities out there.
Super. Yeah, and what I like about that reshoring trend and things, basically the global economy becoming less global, is it's a multi-year cycle, and so domestic focused companies, which tend to be more small mid-cap, could be poised to really outperform. And this may not be a one-year thing; it could be, like you say, a multi-year thing, right? As this develops.
Yeah, the small and mid-cap stocks are a little more volatile, so you want to have them in your portfolio,
right,
in the right amount. It's you want to protect for that volatility. But yeah, it's something we think that does have legs, this reshoring and those kind of opportunities.
Super.
And the market's less efficient, as you know. Under 10 billion, the market's
Yes.
less efficient. There's the companies are less followed. We think it's some good opportunities.
Yeah, that's a very good point. If you're an active stock picker, there's more opportunity in that space to add value. Most definitely, we've seen that time and time again. So,
Yep.
Yeah. So, well, Scott, I know we could cover a lot more, but I thank you very much for joining us for our quarterly outlook video and kicking this off for 2022. I know this isn't going to be the last time we're going to see you this year, because we did a virtual client event in November of last year, and it went over really well across the country. We had almost 1,000 clients sign up for it, and people across the country. So I know we're planning that again with yourself and the research team, answering questions for our clients and talking about your views. So we'll stay kind of tuned to when that is. And thank you very much for joining us today.
Yeah, thanks, Kevin, and I look forward to another exciting year in 2022.